Today is Monday, April 3rd, and this is the ADM Investor Services weekly market kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, and Alan Bush, ADMIS Senior Financial Economist. Starting with an interesting question this morning, Alan, what is the impact of the OPEC plus crude oil production cuts on the financial futures markets?
Okay, well, initially, the markets responded as if this would be inflationary. And of course, normally higher energy prices would be inflationary. But when you think about it, it's really more deflationary than inflationary because the rest of the economy is adversely affected by higher energy prices. So the markets, I think, misread this initially, with the financial futures markets, at least in the interest rate markets, lower, stock index a little weaker, dollar higher. So all that has reversed. So view this as deflationary, not inflationary. And that would suggest, at least today, the way the markets misread this, that we'll probably see follow-through strength in stock index futures over the near term, follow-through gains in the interest rate futures markets, and maybe a little more pressure in the dollar.
Makes perfect sense. Alan, what economic reports this week could have the most influence on the markets?
Okay, on Tuesday, we'll have factory orders guessed at down 0.4%. Also, we'll have the February JOLTS, which is jobs opening and labor turnover survey, guessed at 10.4 million. Wednesday, the March ADP employment report, guessed at an increase of 200,000. Then on Friday, the employment situation with the non-farm payrolls guessed at an increase of 240,000 and the unemployment rate to be unchanged at 3.6%. I'm thinking, though, that most of these reports will come in weaker than the estimates.
Alan, fundamentally, what are the dominant things affecting the interest rate futures right now?
Okay, well, first of all, the dominant influence is the prospect of a weaker global economy. Also, from time to time, we may get some flight to quality buying, as we did with the banking situation several weeks ago, as a fundamental taking futures higher. Also, there is a growing feeling that central banks may be less hawkish going forward. So there are a variety of fundamentals that, to one degree or another, from time to time, will exert a bullish impact. So any breaks should be used as buying opportunities across the board in the interest rate market futures.
Alan, the banking crisis that we saw, or near crisis that we saw a couple of weeks ago, is that completely behind us at this point?
It largely is, but there's still an ongoing concern that there could be some other problems down the road of a similar nature. But for right now, the main impact on the markets has subsided, but cannot rule out some additional flight to quality moves. So that may still be a factor. And if it does come to play, again, that, of course, is bullish, the markets.
Mark, turning toward the grain markets, on Friday we had a big USDA quarterly stocks and acreage report. What was the news there? Any surprises?
On the acreage report, there was a little bit of a tilt towards higher corn acres with a little bit fewer on the soybean side. Corn acres at just under 92 million were at the high end of the range of expectations, and soybeans at 87.5 million acres were at the low end. I think moving forward, we might see a little bit of a effort to shift a few acres back from corn to soybeans, given the tighter stocks outlook there. In wheat, winter wheat acres were a bit above expectations, while spring wheat acres were below expectations. But probably the biggest surprise was the stocks data in the soybeans at 1.685 billion bushels. That was nearly 70 million below expectations. And for now, I look for the USDA to carry a higher residual figure in their balance sheets to adjust for the lower supplies. Ultimately, I think next September we'll see a downward adjustment to last year's production. But as a result, the old crop ending stocks situation does present a tougher rationing job than previously expected.
Mark, key factor for grain price movement this week?
First off, will be how does the market respond to this surge in crude oil prices, given the surprise production cuts announced over the weekend from the OPEC plus nations. After weeks of selling, will managed funds now take on more of a risk-on buying approach, or will the higher energy prices prompt worries that the Fed will continue to hike interest rates to get inflation down to 2%? So that's something that we'll just continue to monitor as we move through. And right now, obviously, the risk-on approach is winning out.
Lastly, Mark, how about an update on the crop in South America?
Recent rains across Argentina have helped stabilize conditions there. The rains were too late to provide much benefit to this year's crops, as they're in their early stages of harvest right now. So I look for further production cuts in the USDA in the next week's WASI report. In Brazil, soybean harvest has just reached the three-quarter point. I look for slightly higher production here to partially offset the lower production in Argentina. The second corn crop in Brazil, plantings there are pretty much completed right now. Moisture levels are good. However, another round of soaking rains by mid-April are needed to keep production prospects strong.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.